Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, Jim, good to be with you on our Friday morning with the listeners and all. And we haven't got any questions this week, so...
Well, and if you do have questions for Bob, and yes, it is pretty unusual for us not to have questions, you can send them to info@howstreet.com. Bob, some of the headlines that caught your attention today, we'll get to those. But first of all, maybe a comment on what kind of a year has it been for commodities so far?
It has been incredible. Sort of a year ago, it was straight up for commodities. There was going to be shortages forever. Then with the rumblings around of in Ukraine that they were not going to be able to ship wheat, and that was it. Commodities forever. And but the most incredible one was with this lithium. Became quite the buzz phrase. Everybody had to have a lithium stock. So lithium went up to 600,000, and this is, I think, in Chinese. It's yuans or whatever they call them.
Yuan, yeah.
But never mind. It's just the numbers that. So it continued. That was just in November. Lithium straight up to 600,000, and then it started to come down, and then it started to crash. So when it was getting down to like 250,000, the Chinese authorities and producers and whatnot decided that they would put in a support price. It would the part of the announcement was it would help the producers, and that was at 250,000. And I'm looking at the price of it today. 178,000. Now that's more than fallen in half, and only since November. So that's one very high-flying commodity. And then you had a massive drop in energy prices from basically around June last year or so. And this is a fascinating thing because everybody was on the commodity bandwagon, and you've got commodity guys that are bullish forever, and they're always talking about the great commodity cycle, and here we are, this kind of thing, and they've been calling it for decades. But commodities go up, commodities go down, and they certainly can become very speculative on the way up. So here we are. We've had the biggest boom in commodities actually was a double top in 2008, and then another in 2011. Silver got up to $50 in that one. In 2008, crude got up to $147. So then that was a big global commodity boom. And I remember doing base metals in the 2007, 2008 peak in commodities and deflated them by the producer price index. And the percent gain on, say, copper or nickel or lead at that time was extraordinary. It was like double the big boom in commodities in 1920. So it was the biggest boom in 100 years. And, of course, this has then set up the biggest financial bubble in history. So, but on commodities, they might have, there was a little rebound. Like copper, you can get a seasonal up to March and then another seasonal attempt into July. But they're weakening. Crude had a nice rally up to 84. Now it's down to 79 in only a few trading days. It was gone. So what are commodities telling us? One, the big inflation story is not going to hold, and in maybe 6 to 9 months, the inflation at the retail side level will come down to much lower. And then the other one is that the commodity prices kind of reflect the pricing power of industry. And when commodities are weak, the pricing power is weak, and these guys are not making much money. And when they're not making much money, then the credit rating agencies look at their debt quality and start downgrading. So this then, weakening commodity prices will eventually have an effect on lower grade corporate bonds, junk, that sort of stuff. So it's been a fascinating world because everyone virtually last year was forever bullish on commodities. And then as we looked at it, you had the sentiment numbers very high, and then you had in various commodities very overdone technicals. They were overbought like you wouldn't believe. So that was a reasonable call. I mean, in June, the headline on a special article we put is that the bear gets everything, including energy prices. So, anyways, that's the key now is weakening commodity prices, and that is one of the features of a post-bubble contraction.
Now, one of the headlines that caught your eye was tightest supply in 18 years boosts copper prices. Is copper the exception?
No, it reached its high early in the year, sold off, and now it's trying to rally. But I couldn't quite grab that headline because it wasn't going with the price action. I don't know whether the guy had accurate data or not, but I didn't bother reading. I just thought, hey, it's a sensational headline. So
we'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, one of the headlines that caught your attention, U.S. financial institutions hit by deposit flight as clients seek higher returns. Yeah,
there's a double handle of that one. One, they're losing depositors. The other is that the depositors are trying to seek a higher return, and that's dangerous. So, when you start reaching for yield, you're also putting yourself at risk. Yep.
Now, for higher returns, where are they taking their money, do you think?
There's the junk bonds, for example, are still priced. They're getting the prices come down a little, but the junk bond rally over the last year has been terrific, and but it's only just beginning to the rally is just beginning to roll over. So I think that probably in the fall, junk bonds will get hit quite hard. So.
Headline, Goldman Sachs misses revenue estimates after taking $470 million hit on Marcus loans.
Yeah. Now that was Goldman Sachs. You know how big and prestigious they are. But they took a massive hit here on I didn't take the time to look up what company Marcus is, but at any rate, they took a whack. Yeah.
Now, a few years ago, I remember it was very hard for condo developments to get insurance, and it looks like other people are getting a little stingy with insurance lending. It says office building owners snubbed by insurance lenders.
Yeah. Now, the way I read that one was that these are insurance monies being invested. It wasn't denying insurance, because it says snubbed by insurance lenders. So institutional money is not going into funding office buildings.
Right. We have huge office building vacancies in Canada and the U.S. in Calgary. I believe I just saw a report where 5 of those office towers are now being converted into condos.
Yeah. Where buildings can be like that can be converted economically, it's a good thing. Yeah.
Although I think it was Hilliard Macbeth who said buildings built in the 80s don't convert well. It's cheaper to just blow them up and start all over again.
Well, I saw one just the other day about in China. They'd built the biggest building in the world.
Mm-hmm.
And this was for all kinds of things. It was not a straight-up tower, just a huge building and all kinds of space and offices, everything else. And then it prompted me that in 1928-29 in Chicago then, as it now, was a place where a lot of manufacture was done, and retail goods and everything else would be shipped into Chicago, then reshipped out to all kinds of smaller places. So they built the Chicago Show Mart building in, I think, 1928, and it was then the biggest building in the world. And, of course, with the stock market crash, the building became essentially empty for quite a while. And I think it was about 1950 or late 40s when Joe Kennedy of the Kennedy family bought the building. And I don't think he saw anything positive out of it until the late 1950s. So when real estate, either office or commercial, goes bad, it can go bad for a long time.
Headline, U.S. stock bulls ignore 100 years of recessions at their peril.
Yeah, that was a good one. Yeah, there's signs that the economy is slowing. And one of the things that we've gone on about frequently is the yield curve, Jim. That's the difference between long rates and short rates. And when it inverts, where short rates get higher than long rates, that has, I've got a chart back to 1857 or something like that, and every inversion in the yield curve has been followed by a recession without fail. So the yield curve has inverted, and it's backed off now, but that's also a sign that's saying, hey, maybe the recession is coming. And short rates, like T-bill rates, should start to come down. And I saw one yesterday, and I didn't have time to follow it up, but the 1 month T-bill rate really plunged yesterday. So that's worth taking a look at over the weekend. And then there was another headline here. The FDIC, that's the Federal Deposit Insurance Corp, starts selling $114 billion of bonds from failing banks. So this is how the poison spreads. The banks fail. They were holding bonds. So then the Federal Deposit Insurance Corp ends up taking the bonds, and then they can't hold them forever, so they then start selling them. It feeds into itself, doesn't it?
Yeah, it certainly does. Wolf Richter, who will be on This Week in Money, points out that in the U.S., having 3 or 4 bank failures a year is normal. I think what really caught everybody's eye, though, was the size of Silicon Valley Bank. It was the second largest bank failure ever.
Yeah, it was. It was a signature item, that's for sure. Now, what I did historically is like the market, the last bubble completed in September 1929. And then in the U.S., the first run on banks began in September of 1930, the following year. It seems to take that long where highly leveraged players with the crash are wiped out immediately. It takes longer for the insolvencies to be discovered elsewhere. And that was with a string of banks in the southeastern states, sort of focused in Tennessee. And that was where that bank run started. So then I looked at what happens when the big banks fail. And in Europe, you had the Credit Anstalt Bank. And it could be an instruction for today because as the financial markets became precarious in 1929, the authorities encouraged Credit Anstalt, which was the power bank, to bail out smaller banks, which they did. And then in May of 1931, it was discovered that its balance sheet couldn't handle it. So when Credit Anstalt failed, that was a big bank in Europe, and that was a real disaster. So that then put, a massive deflation around the world of everything, and then that phase of the crash went right down until in July of 1932, and that was the washout bottom. Oh, and that prompts one, Jim, that in Barron's, the highly regarded financial publication, they editorialized in July 1932, and it pointed out that the nub of the editorial was that every anti-deflationary measure taken by the Federal Reserve System is seen not to work. And the anti-deflationary measures by the Fed were buying bonds out of the market. So many economists have accused the Federal Reserve in 1929 as being tight, and that forced the Depression. But you get a little tidbit like that points out that the Fed was trying to liquefy things all the way down as best as it could. And then I read the Economist and Barron's and the Wall Street Journal and various other periods through that July of 1932. And what happened is over a couple of week period, the selling by bonds ended. And then, whoomp, you turned around and you had a terrific rally for everything. It was the end. So the selling of bonds is really important in the business cycle. And it's going to get a little worse this come fall. Yeah.
Headline, U.S. banks highlight office real estate as their next big worry.
Yeah, office real estate. Well, we were just talking about empty office in Canada and the U.S., and where possible, they can convert them to residential, which is a great idea. Yeah.
And our final headline, Americans are struggling to pay off their car loans.
Yeah, though that gets right down to home, doesn't it, where you've got your car and you got your payments, and they'd be interest rate sensitive, so everybody gets jammed. It's interesting. I picked the headlines for how sensational they are. And a year ago, it was sensationally bullish. Now it's sensationally, troubled stuff. And so you've got here from big banks right down to folks with their cars under pressures. And sadly, that's the way it goes. Yep.
Bob, thank you so much for the update.
Yeah, Jim, good to be with you, and we look forward to next week.
My guest has been Bob Hoye, the Chief Investment Strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@housestreet.com. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.